What is going on, everybody? Welcome back to another video. In this video we are going to go over how to make money whether the market is going down or up using options and how to reduce your risk dramatically. So with that being said, let's go on ahead, cue the intro, jump right into this video.
I know I'm fine, but the money
Okay
makes
guys, so the first thing first is everybody is going ahead, look at the market, SPY, Qs, whatever you want to look at. It is up technically, but a lot of people are very skeptical, including myself. I am skeptical, but I am still more bullish than I am bearish. But say you're the opposite, you can do some different things here in order to protect yourself. I think that's one thing that people don't remember or realize, or if you're new to options, is you can hedge using options as well. Or you can do exactly what a lot of people teach, or some like Tasty Trade teaches, where they're net neutral. And what does that mean? Is you are willing to play both sides of the market. So why I have Robinhood is we're going to show you that exact case scenario, is because I have a lot of people, and you can do these in iron condors or strangles. I don't remember if it's a strangle or straddle. I always get them mixed up, but it's this trade. I'm going to show you the exact trade here. And again, you guys can do this on a much smaller scale on different stocks. It's completely up to you. You can, broken wing butterfly these. You can leg into them. However you want to do it, it's completely up to you. But I'm going to show you the whole trade. So this is SPY, the S&P 500. And then I'm going to go out to my normal 45 days. 45 to 35, somewhere around in there. 30 days at least, normally. But we'll go 44 days. And so we are bearish. So the most important position, if you are bearish or you are net neutral, is both sides, of course. But we're going to start with the calls because it's already up here. So the first thing you're going to do is kind of figure out a spot where you don't think it's going to go to. You can use the deltas, whatever you're looking at. The delta is right here. It's basically the probability of it going in or out of the money. So if you click sell, it'll see chance of profit. They use the delta in order to calculate this. So what I do is, and I've told you guys all this, you guys can make up your own rules or however you want to do it. My thing is I go out to that 10%. So this one's an 11. That's very close to me. I'm going to sell this one. Now, what am I going to do in return? Is I'm just going to find another one that's pretty cheap. And right now, since the market was technically up, we are just going to look. It's a 42 profit on $500. I'm willing to risk this to play both sides of the market. So I'm going to leave this trade here. And now you can remember, you can do this trade and then wait for a red day and go do the put side, because you're going to do the exact thing on the put side. You're basically just doing two credit spreads together, which creates an iron condor, or you can trade these naked. So I'm going to show you what that is here. So we have selling on this one, and then you're instantly going to flip over to the put side, and we are going to go down. You guys know I like my 20 to 15 rule right in there, depending on what it is. I'm going to go with this one right here, and now you guys can see we have this trade, where as long as it stays in between 464 and 500, so let's mark those just for demonstration purposes. 500 is quite a bit up here, so it's not going to just let me see it. So 500, and then the other one was 464. So we did get up there a little bit. You're not near as far actually on the bottom side, because our delta is a little bit more up there. So again, what we can do if we want is we can change this and say you just want to go out to those 10 deltas. So we can go out here to about that 90% and still collect 102. But again, your risk right here is smaller, but your reward is also much smaller on the put side. And this one would be 445. So click the wrong tab here twice now. 445 is going to be dramatically different. Yeah. So as long as the stock stays in between these two lines, you are going to max profit on this. And again, you guys can do this on other stocks, but you're basically going to collect $200 or $1.93, which is $193. That's how you can play both sides, or you can do the other side of this as well, which is probably what a lot of people should do. Since we've already created these strikes, I'm going to go on ahead and just flip it back to buy. And I want to collect a little bit of premium here, at least. So the spread between 67 and 102. And then I'm going to flip back over to the call we have up here. And I'm going to flip it here. And now this is where you're going to see I'm going to basically, what is that, 10%? $1,000. Now it's less than 10%, probably about 7%, 7.5%. $77 for my max loss of $918. Guys, for a lot of beginner accounts to do these, it doesn't involve as much capital. You're net neutral, so the market has plenty of room to move, and you can make money on it. Again, these are credit spreads. You're just putting it all together. It's your short iron condor. It says it right here. It's a very, very simple trade, but it reduces a lot of risk. And I think this is one thing where people aren't sure where the market is. You still want to collect those premiums. You still want to collect them and be able to play both sides. And again, this is one trade that you can adjust. So as the market moves up or down against you in one of these legs, because it's more than likely going to over the next 45 days, you can manage these. So like a lot of people say the golden rule is 21 days. So when this trade got to 21 days, you would then be able to maybe roll up your put side if the market has dropped. And then this one will be pretty much just home free. Or you can do the opposite, is you can keep this down here and you can roll the opposite side down here. That way you collect a little bit more premium on that one. You can roll up the uncontested side. A lot of people seem to roll up the contested side because you're going to collect more premium, and eventually it's more than likely to bounce unless we just get a downside wave that's dramatic. Again, these are just examples. 100% here. These ones are just a lot more expensive for your account. So if you don't have a big account, I don't recommend even trying these even on smaller stocks. For instance, one that's like SoFi or PLTR that a lot of people are into. I'm not saying these are bad stocks whatsoever, just so everybody is very clear. I just have the capital, thankfully, that I'm able to trade better options and things like that, and better stocks. Let's put it that way. So I'm going to sell a call. I got to at least collect some premium. Chance of profit, I'm probably going to go up here to this one right here, $26. Right, yeah, that's on the call. I just always want to double check. And then I'm going to come down here, chance of profit on this 5, collect $5. But again, collecting $31, it's still not worth. Again, your max loss is unlimited theoretically. That is the worst case scenario in this market, and you can manage it before that. So with that being said, guys, thank you guys for watching this video, and I will see you guys in the next one.